Today we're going to cover how somebody with a net worth of 7 million might actually end up with 50 million by the time they are fully retired. And that might sound like a big jump, but this particular person is open to alternative investments. They're open to taking a bit more risk than your more traditional vanilla 60/40 stock and bond portfolio. And so in this video, we're going to break down the actual assumptions that we're making in order to get to that math and how some of those assumptions might change because we obviously don't know the future. And so if you're interested how somebody who is already fairly wealthy might be able to live off the income of their portfolio and let their principal compound over time, this should be pretty interesting. All right, so let's dive in. All right, this is our client dashboard. We are protecting the names of the innocent here, but we're going with the Davis family for this example. This family is worth $7 million. That includes assets like real estate, their investments in private equity, their stock portfolio, their bond portfolio, some venture capital investments. Not too much because we know that's fairly risky. Same goes for Bitcoin. This family likes crypto in their portfolio. This, of course, could be gold or other metals that hopefully are an inflation hedge for another investor, but this particular family is okay with crypto. And then a fairly substantial cash account, which is pretty high, but there are some unique circumstances like funding some of the private equity investments. And so you want to keep some cash in a money market fund and liquid. This could be short-term treasuries too, but this is a little bit high compared to most clients out there. Okay, back to the dashboard. And so we want to think about a few things here before we start projecting the net worth into the future. We want to make sure that we have sufficient cash on hand. Of course, we want to think about our historical returns and how our net worth is compounding over time. We want to think about how much tax exposure, tax liabilities upcoming if we sell some investments in the near term. So this is really important to track, of course. The breakdown of the various investments as a component of our net worth, both assets and debt, and further breakdown. And so all of this is getting a very clear picture of where we're at. And so we can think about where we're going. Looking out into the future, we want to make some assumptions about how the investments are going to grow. This particular investor is comfortable with 11% return projection, and that is going to include some healthy alternatives in their profile. Then we're assuming the salary from his business continues to grow. This is an entrepreneur. He feels very comfortable with the business. It's in a steady industry. So he's projecting 5% per year. And he, like most of our clients, is not planning on a traditional retirement at 62 and just taking Social Security. This person has big ambitions, wants to continue to work as long as possible. But just from a planning standpoint, you never know. We don't know what's going to happen. So we want to make an assumption about that work stopping at some point. And so we think through a couple scenarios, but just for planning purposes, we're going to assume he stops taking an income and it stops growing at age 70. And then the expenses, how much they're living off currently, of course, that's going to grow with inflation. And then there's a couple custom assumptions that this person wanted to include in their projection. And of course, we can come in here and we can change any assumption. We can say, oh, what happens if inflation's actually zero? Because abundance will be everywhere. AI and robots will take care of all costs and decrease pricing. So then we have all of a sudden a $62, $63 million net worth. By age 66, he's 46 today. But of course, it's more reasonable to assume that we are going to have some inflation and that $62 million in the future is really $42 million into today's adjusted money. So some people like to see the heavy numeric version of this. Of course, we go into the chart version and model this out over time to see how the math ends up working out. All right, so as you can see, this person becomes quite wealthy over time because their principal continues to compound in excess of their $180,000 a year in expenses that they're taking for their lifestyle. That would grow with inflation in this scenario, but still, there's a healthy amount of money left over from their $300,000 that they're taking salary that they can put that excess and reinvest it back into their portfolio. And so the compounding continues to happen. Now, that's a great outcome. His family would obviously be quite thrilled with that. All right, so that's great, but that might not be the exact outcome that happens. We might end up with lower returns than we thought. So we want to consider a different scenario. That's this version right here with lower returns, 9%, or we can even be more conservative and just say our stocks are, say, maybe going to go up by 8% a year. And maybe something happens with the health or the business and we don't continue to grow that income every year until this person's 70. So we can make adjustments on income to be a little bit more conservative and to prepare a downside case is how I like to think about it. Some people like to consider 1,000 different options. We like to focus on our base case and our downside case. That is a very common strategy in private equity, in real estate private equity, which is my background. You can model these things until the cows come home, but we like to keep it fairly simple. This is also why we don't have 50 different line items here of assumptions that we can change. Because once you start going past 10, 20 different variables, the model actually becomes less helpful. You can't act on the information, on the conclusions that it's making for us. So we like to keep things broad in the most important categories, make these assumptions, and then move on with our lives, implement the strategy, and stop worrying about the nitty gritty details of 5,000 possible things that we could change in these models. I get furious when I see these plans, these investment policy plans that are 100 pages long, where there's no chance that the client's even going to look past the first page after day one. That plan becomes worthless the second it walks out of the office. So I would encourage you to focus on the big drivers, the big things that move your financial future, that move your investment portfolio forward. Stop worrying about, are we going to take 3 vacations or 4 vacations, and how do we model that? What if inflation is 2.1 versus 2.3? What if we do a Roth conversion in year 8 versus year 9? We don't like to do that at all. If you are an engineer and you have to have every single possible scenario laid out in front of you, God bless you, but there's other tools, there's other companies for that. We once again are focusing on the big drivers, the big needle movers, the most important investments that can really drive outcomes. At least that's how we think. Okay, and now we go into some of the alternative asset classes. Maybe the alternative investments don't do very well at all. Maybe they only return 8%. This would be unusual. Historically, alternative assets have done quite well. They've done higher than the overall stock market because you need to get a premium in order to deal with that illiquidity. But let's just assume it matches the stock market return, and this individual family has a lot of alternative investments as we covered in their asset class, right? Private equity, real estate investments. So that dropped net worth pretty substantially in the second scenario here. We have a negative assumption on Bitcoin. We're assuming in this scenario that Bitcoin was a total flop. It goes to zero. It was nothing. It's vaporware. So in other words, that 70K that he has invested today in Bitcoin is worth zero. And then at the bottom here, you may have noticed that we have now a 5% interest rate on bonds. This might be a little unusual, but I think in a world where we're assuming that stocks aren't going to return that much, 8%, a little bit lower than historical, same assumption we made here in alternative assets. I think in that world, well, bonds should be earning slightly higher interest rates than they are today. Anyways, not a big assumption, but you can see it is slightly higher than it was in the first scenario. So that's a way to bracket our outcomes with a $7 million portfolio today that could sustain this family under fairly different assumptions from a return standpoint. And you'd be surprised. Somebody that is worth $7 million today, you would think they would be fairly comfortable. They wouldn't be as worried about their future net worth. But no matter how much money you have, most people have some level of anxiety about their finances for different reasons, right? They're obviously not worried about what they're going to be spending at the restaurant or the vacation that year, but they can worry about the future. They often don't want to lose what they have, or they feel a deep sense of responsibility about this money and growing it and maybe gifting a lot of it to charities in the future, obviously leaving a healthy amount for their children and their legacy. And so this exercise can remove a lot of that anxiety, can help people stop worrying about how their investments are set up or how much they're going to have in the future just by walking through the math and toggling and going through the various assumptions, doing some planning on the tax front, getting in front of that aspect of their finances. And so just giving this overall comprehensive but simple view into their future is a powerful exercise, and it can help people get crystal clear about where they're going. If you want to go through that analysis for your family, reach out to Evergreen Capital. There are resources down below. Thanks for watching.